Lecture 6, Incentives, Innovation, and Entrepreneurship. The founding pillars of Economics for Leaders, the curriculum upon which Economics Online for Teachers is based, are the 5 economic reasoning propositions you see on the screen. Hopefully, you're familiar with these from recently completing EOFT Part 1, or you've reviewed the PowerPoint linked in the introductory lesson. These 5 propositions are essential tools for developing the economic way of thinking, critical thinking skills that help students make decisions in their own lives and understand how people's choices shape the world they live in. In Economics for Leaders, we've chosen to apply the basic tools of economic reasoning in the context of world poverty. We ask, why are some countries rich and others poor, in order to make a case for why we and our students should care about economics and economic reasoning. The first 5 units of Economics for Leaders are the basis for EOFT Part 1, where we began, as all economic inquiries begin, with the fact of scarcity, that ever-present challenge to make a big enough economic pie of goods and services with our limited resource ingredients. Moving from poverty to comfort to wealth is essentially the process of getting a bigger piece of the pie. And we looked at the history of world economic development to compare 2 methods for doing so: redistribution and economic growth. The evidence, remember economic reasoning proposition number 5, that opinions are only as good as the evidence that backs them up? Well, the evidence clearly comes down on the side of economic growth as the path to better lives for the world's poor. Given that reality, the next logical question is, why do some countries and regions experience economic growth and others don't? And the short answer to that question is that they have different institutions. Institutions are the social arrangements that Nobel laureate Douglass North famously called the rules of the game. Another way to describe them is that they are the accepted and expected formal and informal rules of interaction in societies. As we'll see, in the context of the wealth and poverty of nations, institutions make all the difference. Here's the Fraser Institute's Economic Freedom of the World map, in which countries are ranked based on the presence of institutions that Fraser associates with economic freedom. It turns out that to measure economic freedom, Fraser measures the strength or weakness of the same institutions that we identified in EOFT Part 1 as being associated with economic growth: open markets, property rights, the rule of law, and entrepreneurship and innovation. The stronger the presence of these institutions, the higher the nation on Fraser's ranking of economic freedom. Generalizing, bluer on the map means more or stronger presence of the institutions we've associated with economic growth, and redder means less or weaker presence of these institutions. Now, what happens if we compare nations' institutional rankings with their degree of wealth or poverty? Here's our map of rich and poor countries. The colors aren't exactly the same as in the Fraser map, but again, generally bluer is richer and redder is poorer. If we put the Fraser map next to the per capita GDP map, the correspondence is readily apparent. Bluer equals stronger institutions, richer countries. Redder equals weaker institutions, poorer countries. Here's a graphic representation of that same institutional data. It illustrates even more clearly the relationship between economic growth, that pathway out of poverty, and the strong institutional presence of markets, property rights, rule of law, and entrepreneurship. The 4 vertical yellow bars are generated by dividing the country ranking list into quartiles. Fraser calls the 25% of countries at the top of the list the most economically free. That's the yellow bar on the right. For our purposes, let's think of them as the countries with the strongest growth-promoting institutions. The bar on the left is the lowest 25% of countries, where those institutions are missing or weak. And the vertical axis measures economic growth. the contrast between growth rates is stark, isn't it? And it's even more striking if we think about the graph in terms of how quickly people's lives can improve. Using the rule of 72, we can estimate that GDP per capita in the upper quartile of countries would double in about 26 years. That's not bad, is it? 26 years is about a generation. So, in those countries, people can expect to see significant improvements in their standard of living during their lifetimes. Even for the two middle quartiles, the doubling time is only about 36 years. But at 0.4% annual growth rate, the doubling time for the people in the poorest countries is 180 years. And think of the level at which they start to double. What a bleak future. As we said, institutions matter. Okay, so that's the context in which Economics for Leaders develops the tools of economic reasoning. In EOFT 1, we concentrated on the first three economic reasoning propositions, developing our understanding of scarcity, choice, cost, and incentives. Then we jumped into the study of markets, the first institution on our Promotes Economic Growth list. Lessons 3 and 4 in EOFT 1 took us through supply, demand, and price, and in Lesson 5, we applied the economic reasoning tools to labor markets. EOFT Part 2, our present course, continues with topics 6 through 10 of the Economics for Leaders curriculum. Lessons 6 and 7 examine the other institutions associated with economic growth, entrepreneurship and innovation, property rights, and the rule of law. We'll be emphasizing economic reasoning propositions 3 and 4, but that doesn't mean you can forget numbers 1, 2, and 5. Scarcity, choice, opportunity cost, and the importance of evidence are essential tools we always carry in our economic analysis kit, and we'll continue to use them throughout this online course. Nonetheless, propositions 3 and 4, institutions and incentives, will be our primary focus. In this lesson, we continue down the list of institutions to entrepreneurship and innovation. Proposition 3 reminds us that entrepreneurs and innovators, like all people, respond to incentives in predictable ways. Their perceptions of rewards and punishments shape their behavior. And the connection to institutions is that the rules of the game shape the incentives that influence the heroes of our story, the entrepreneurs and innovators who generate wealth. To appreciate how devastating the lack of entrepreneurship is to developing countries, consider how it works in the economies of developed nations. Entrepreneurs are the organizers who acquire and use resources in production. Of course, lots of people work in the productive process in some way, but what distinguishes entrepreneurs from other workers we call labor, is that entrepreneurs assume the burden of risk that comes with trying to satisfy other people's wants and needs. That willingness to risk sets entrepreneurship apart from labor. Growing up in robust market economies, we tend to accept entrepreneurs as a vital part of our society, almost without thought. But the realization that entrepreneurship is fundamentally different from labor, and that difference is important and valuable, is a relatively new understanding in the history of economic thought. And sadly for our theme, it's a notion that has yet to be fully embraced by the developing world. Understanding of entrepreneurship as a force in the Western world began to develop in the mid-18th century with the writing of the classical liberal economists. In the United States, we celebrate 1776 for the writing of the Declaration of Independence, but the student of economics knows that it's at least as notable for the publication of Adam Smith's seminal work, An Inquiry into the Nature and Causes of the Wealth of Nature. It would be hard to overstate the influence of Smith's ideas on our lives today. The American founders were well acquainted with liberal economic thought, and they deliberately created a set of laws and institutions that supported markets as our primary means of dealing with scarcity. And they deliberately created incentives that encouraged entrepreneurship and innovation. Smith and the founders knew that the difference between entrepreneurs and laborers is important. Laborers are sellers of resources, exchanging what they have now, their time and talents, for wages. Entrepreneurs are investors who risk the resources they have now in the expectation of profit in the future, knowing that there's no guarantee. Entrepreneurs are sometimes called residual claimants. The residual is what's left, meaning that the entrepreneur claims what's left when the transactions and exchanges are complete. Great for the entrepreneur if it's profit. Too bad for the entrepreneur if it's a loss. But that was the risk. You start a business and you claim the residual, whatever it is. This sounds harsh, but as we'll see in a minute, the profit and loss dynamic is essential to the overall health of the economy. Before we get to that, let's look specifically at the incentives that encourage entrepreneurship. On the screen, you see one of the most well-known quotes from Smith's The Wealth of Nations. It is not from the benevolence of the butcher, the brewer, or the baker that we expect our dinner, but from their regard to their self-interest. We address ourselves not to their humanity, but to their self-love, and never talk to them of our own necessities, but of their advantages. Bottom line, entrepreneurs, like all other human actors in the economy, are self-interested. Unfortunately, that classic statement about incentives and motivation is often misinterpreted as a justification of greed. But if you think about it, and as Adam Smith himself asserted, self-interest doesn't have to be greed. Paul Hayne, author of The Economic Way of Thinking, characterized the pursuit of self-interest as working toward the goals and projects that interest us. And he noted that while it's true that some people are selfish and their self-interest greedy, that's not necessarily or even often the case. Even the most altruistic of individuals is self-interested, working to advance and benefit the altruistic projects that interest them. Hayne also pointed out that while, yes, it's true that profit motivates them, we can't condemn entrepreneurs based on that fact, because we don't know why they want the profit. Profit is a means to the entrepreneur's ends, and when we don't know what entrepreneurs do with their profits, we can hardly make judgments about selfishness or greed. Adam Smith's genius was not in recognizing that entrepreneurs are self-interested, but in describing how the incentive of profit harnessed that self-interest to the well-being of society. He explained the institutional dynamics that draw out entrepreneurial talent and at the same time harness it to wealth-producing economic growth. Smith's revolutionary observation was that because of the incentive of profit, we don't have to rely on producers' altruism to get the goods and services people want and need. In explaining how the profit motive works, he took the focus off the character of the individual and turned it to the institution, the rules of the game. Well, Smith himself was very concerned with morality. In fact, he called himself a moral philosopher. What he discovered is that people in market economies must work to the benefit of others, whether they want to or not, whether they're good people or not, whether they care or not. If there's profit to be made by providing a good or service, someone is likely to take the risk of doing so. And if producers can't earn profit by providing a particular good or service that consumers want, then they're unlikely to do so. And again, it doesn't matter how nice, caring, or compassionate they are. Adam Smith insisted that we can rely on the profit motive to provide socially beneficial outcomes regardless of producers' character because of competition. He called competition the invisible hand and explained how it constrains the actions of the entrepreneur. Historian Robert Heilbronner, writing in The Worldly Philosophers, summarizes Smith this way: "A businessman who charges too much for his wares, or refuses to pay as much as everybody else for his workers, will find himself without buyers in the one case and without workers in the other." The invisible hand of competition ensures that producers make the goods that society wants, in the quantities that society wants, at prices that society is willing and able to pay. Because if they don't, someone else will. Smith paints a picture of relatively powerless producers, but I'd be willing to bet that many of you don't think of them that way. They make us buy things, you say. They have advertisements that lure us into particular markets. Surely, we have to agree that producers do have advertising campaigns that successfully entice people into buying their products, but remember that those purchases are voluntary transactions, and ultimately the power lies with the consumer. In the final analysis, we could say, yes, I'm willing to pay this amount for this particular name brand, or no, I'm not. I can get something very similar that doesn't have the name brand and be just as happy. The misconception that entrepreneurs have a great deal of power in the marketplace is widely held, but it's a misconception nonetheless. Producers can make products, put them on the market, and bombard consumers with advertising. But in the final analysis, it's the consumer who has the power to decide whether or not to pay for those products. For more than a century after Adam Smith, economists focused on price as the competitive mechanism among entrepreneurs in the market. If they wanted to stay in business, they have to compete for customers by finding ways to lower production costs and prices. And then, in 1942, economist Joseph Schumpeter revolutionized our understanding of competition. I've put a quote from his best-known work, Capitalism, Socialism, and Democracy, on the screen, and I'll apologize for reading it to you, but I want to provide some explanation as we go through it. Economists are at long last emerging from the stage in which price competition was all they saw. In capitalist reality, as distinguished from its textbook picture, it's not that kind of competition which counts, but the competition from the new commodity, the new technology, the new source of supply, the new type of organization. Competition which commands a decisive cost or quality advantage, and which strikes not at the margins of the profits and the outputs of the existing firms, but at their foundations and their very lives. So, Schumpeter was saying to economists, get your head out of the textbook, look around you, and see what's going on. It's not the same old stuff just becoming cheaper. It's new stuff, better stuff, that's driving the market. And he said, competition isn't just or even primarily price. It's innovation. This kind of competition is as much more effective than the other as a bombardment is in comparison to forcing a door, and so much more important that it becomes a matter of comparative indifference whether traditional price competition functions more or less promptly. The powerful lever that in the long run expands output and brings down prices is in any case made of other stuff. Schumpeter revolutionized our understanding of market institutions by arguing that innovation, creating other stuff, is the primary competitive tool of the entrepreneur. By noting that we don't know what the next innovation will be, he also added ever-present invisible competitors to Smith's model of invisible hand. It is hardly necessary to point out that competition of the kind we now have in mind attacks not only when in being, but also when it is merely ever-present threat. It disciplines before it attacks. The businessman feels himself to be in a competitive situation even if he is alone in his field. So the entrepreneur not only has to worry about other businesses who can offer his product at a lower price, he also has to worry about new products and new businesses that might pop up tomorrow, satisfy consumers' wants better than he can, and put him out of business. Thinking about it that way ratchets up the level of risk, doesn't it? So, next question. How does innovation work, and how is it tied to entrepreneurship, productivity, and economic growth? In Lesson 5 in EOFT Part 1, we laid out the connection between workers' incomes and their productivity, noting that more productive workers earn larger incomes, and that technology is the key to increasing productivity. Now, although we tend to think of technology as buildings, machines, and tools, it's more basic than that. It's knowledge, the collective body of knowledge that human societies know and have recorded about how to use resources to produce goods and services. Now note that it's collective knowledge. Individuals and groups contribute to the body of knowledge through innovation, but no one holds it all. Invention is the discovery of new knowledge, but importantly, the knowledge itself doesn't help us in the battle against scarcity. We have to go from invention to innovation to make knowledge useful. Wealth-producing technological progress only occurs when invention becomes innovation, an increase in productivity from a market-proven application of new knowledge. So, enter the entrepreneur. Innovation occurs when entrepreneurs figure out how to turn that new knowledge, an invention, into productive use, an innovation. What Schumpeter and economists building on his insights have realized by looking at the economic history of different countries and regions is that, again, in terms of entrepreneurship, institutions matter. Economies that provide incentives for entrepreneurship and the accompanying transfer of knowledge from invention to innovation experience greater economic growth than countries where the rules of the game offer no incentive for innovation or put up barriers. Here's the map of GDP per capita that we started with. Remember that rich is blue and red is poor. Now, compare that map to the World Bank's measure of the strength of entrepreneurial institutions. They call it their Ease of Doing Business Index. Green countries encourage entrepreneurship, and red, which matches nicely the red on our GDP map, discourages entrepreneurs. Think about that process of translating invention to innovation. It's risky. It requires investment in an unknown future. It means foregoing consumption in order to use resources in anticipation of future rewards. There are no guarantees, and the patent office and flea markets are littered with unsuccessful innovations. So, future rewards have to be substantial enough to overcome people's reluctance to assume the risk in the first place. And the greater the risk, the greater the potential reward necessary to get the entrepreneur to invest and take the chance on that new component or process or product. We call that reward profit, but we need to be precise in thinking about what it is. We use the term profit in conversation to mean any gain or benefit, but it has a more precise meaning in economics. Remember that it is specifically the reward or income earned for successful entrepreneurship. Profit differs from wages, that is, the income earned by selling labor resources for use in production. One way to think of it is that wages are associated with work and profit is associated with risk. Now, just as we use the term profit in various ways, we also calculate it differently for different purposes. An accounting profit, for example, is found by simply subtracting the money going out of a business, the costs, from the money coming into a business, the revenue. When you hear in the news that Corporation X made profits of so many $1 million last year, it's likely to be an accounting profit, calculated as revenue minus cost. It sounds straightforward enough, but it misses something very basic to the economic way of thinking. Opportunity cost. Oh yeah, that. If we just think of profit as subtracting money going out from money coming in, it's easy to overlook the opportunity cost of the entrepreneur. Like everyone else, entrepreneurs have alternatives, and making the choice to be in business means bearing an opportunity cost. So, you're a teacher, but suppose you're also a great chef, and you'd like to have a catering business. It's easy to see that when you chose to teach, you gave up the opportunity to be a caterer. But don't forget that it works the other way too. If you now choose to quit teaching and start a catering business, you give up your next best opportunity, which was teaching. That means that your new catering business starts with a big cost, the teaching salary you're giving up. Accounting profit, just calculating money coming in minus money going out in your business, overlooks the $35,000 or whatever you made as a teacher. Now, how much you value that $35,000 teaching salary is surely up to you, and if you really want to be a chef, then the $35,000 salary is worth less to you than being creative or independent as an entrepreneur. So, yes, it's true that it would be hard to capture a dollar figure in an opportunity cost in an equation, but the key point for the economic way of thinking is that we can't pretend that opportunity cost is not there. Economists, therefore, focus attention on normal profit and economic profit instead of accounting profit because they help us better understand economic growth by explaining first what draws people into or pushes them out of entrepreneurial endeavors, and second, how entrepreneurship performs the important task of allocating resources to their most highly valued uses. Normal profit. It's the amount of profit necessary to induce someone to take on an entrepreneurial risk rather than doing something with less risk. Good old opportunity cost. In terms of our teacher or caterer example above, normal profit is the amount of profit you'd have to make in order to give up your teaching job and take the risk of starting your own business. We can't know what that amount will be, and it may not even be that you have an exact dollar figure in mind. Or it may be that the amount it would take tomorrow is different from the amount it would take today. However, we do know that if you leave your classroom and 10 years from now you're still running your restaurant, then you must be making a normal profit, or else you wouldn't be doing it anymore. Now, if you think of normal profit as the absolute minimum it would take to induce people to become entrepreneurs, you can think of economic profit as anything above and beyond that minimum. Economics is interested in economic profit not because of what or how much it is, but because of what it does in the economy as a whole. Economic profit draws resources to their most highly valued uses. So suppose you do leave the classroom to start a catering business. And suppose that in just a couple years it's a big success and you're hauling in money in buckets, way more than you ever thought you'd make, and way more than it takes to keep you from going back to teaching. That way more is economic profit. Big time economic profit. Yay for you! But you'd better enjoy it while you can, before it disappears. Now, you may not be so happy about the disappearing act, but it's great for the economy. It works like this. While you're enjoying economic profits, they're acting like magnets, entrepreneur magnets. There are other people out there like you, people wanting to try something new or looking for ways to make more profit and willing to take a risk. High economic profits in the catering business tell them that that's a risk we're taking. So, someone else starts a catering business, and now you make less profit. But if you continue to make any economic profit, it will continue to attract more entrepreneurs, and more, and more, and more. Now, is that a good thing or a bad thing? Well, in terms of the larger problem of scarcity, it's a good thing. The reason you made so much profit is that you were able to keep your prices high. People were bidding against each other to get some of the limited catered meals you produced. But those same high prices and profits were also like a big sign telling other people that catering's a risk worth taking. The economic profits also made it easier for you and other caterers to bid resources away from other productive enterprises. And again, that's a good thing, because the high prices that led to your economic profits meant that people wanted more than were being produced. So in this way, resources flow toward the goods and services people want most, or, as an economist would say, the resources flow to their most highly valued uses. And the process works the other way too. As economic profits fall, they lose their magnetic effect. Low economic profits push competitors out of the market. And if you're not one of the best competitors in that field, you might be one of the ones pushed out. Bad news for you. On the other hand, we know that if you stay in business, even as the economic profits dissipate, you must still be making a normal profit. The story of rising and falling economic profits fits well with Joseph Schumpeter's conception of dynamic capitalism, in which an ongoing process of creative entrepreneurship generates economic profits, and then the invisible hand of competition makes them disappear. Schumpeter called this process creative destruction, and he argued that it was essential to ongoing wealth. Now, up to this point in this lecture, we've been looking at the benefits of successful entrepreneurship, but Schumpeter's clever juxtaposition of the words creative and destruction serves to remind us that entrepreneurial failure is at least as important as entrepreneurial success to the process of economic growth. Unsuccessful entrepreneurship, evidenced by losses and business failure, frees up resources to be moved into new or more highly valued production. Earlier, we indicated that government policies and other rules of the game encourage or discourage entrepreneurial risk-taking and impact an economy's ability to create wealth. Similarly, the institutional arrangements for dealing with business loss and failure have an effect on economic growth. For example, if the rules of the game make it extremely difficult for individuals to recover from loss or failure, or prevent them from future risk-taking, there will be less entrepreneurial activity. At the other end of the spectrum, policies that rescue businesses from failure or shield them from competition reduce innovation and also have a negative impact on economic growth. We can see the benefits to the larger economy of creative destruction, but we shouldn't be at all surprised that entrepreneurs themselves, especially very established ones, often don't share our enthusiasm. In fact, they have a strong incentive to try to use the political process to keep out competition that might threaten them. If you pay attention, you'll hear about it all the time in the news, ranging from cosmetologists lobbying state legislatures to require hair braiders to take classes and apply for licenses, all in the name of public health and safety, of course, to requests for low-cost loans by failing businesses in the name of compassion for the workers who would lose their jobs if the business failed, even to the issuing of a limited number of taxi cab medallions that makes it a lot harder and more expensive for you to get a cab. Before we leave entrepreneurship, I want to review marginal analysis. It's an economic reasoning tool we introduced in EOFT Part 1 in relation to individual choice and to employers' hiring decisions in labor markets. Here, we're going to see how marginal reasoning influences entrepreneurial decisions. Successful entrepreneurs use marginal analysis to maximize profit, or, in the most unhappy scenario, to minimize loss. First, a reminder that marginal means additional. And in production decisions, as in so many other things, it's the additional rather than the total that should guide decisions. An entrepreneur using marginal analysis compares the additional costs and the additional benefits of the next unit of production, because firms maximize profit by producing up to the point where marginal revenue is equal to marginal cost. Here's how it works. The slide you see in front of you is an example of cost and revenue data for a firm. In this chart, different levels of output are represented in column 1. Total revenue at each level of output, that is, the amount of money the firm brings in from sales, is in column 2. And the total cost of that production is in column 3. Now, this is a competitive firm that can sell all it produces for a price of $3,700 per unit. So, if the firm can sell everything it produces, why doesn't the owner just keep increasing production? We might be tempted to answer that question by comparing columns 2 and 3 at each level of production. Okay, so we notice that the firm continues to take in more and more money, even if it increases production up to 10 units. But the costs in column 3 are increasing too. Now, up to 9 units, total cost is still below total revenue. But at 10 units, it jumps way above the amount the firm could make by selling all 10. So it's obvious that the entrepreneur shouldn't increase production by 10. But if you conclude that he should increase production by 9, you need to pull out your marginal reasoning skills. Important information is hidden when we just look at totals. The next two columns are marginal revenue and marginal cost, the additional revenue and the additional cost of producing one more unit. The additional revenue for each unit is $3,700. Remember, the market determined that people would buy as many as the company produced as long as the price was $3,700. But look at the marginal cost. For lots of reasons having to do with space, time, and resources, costs, marginal costs, unlike marginal revenue, is not the same for each additional unit of production. That's the information that was hidden when we just looked at totals. So go down to Unit 9 again. Yes, total revenue is greater than total cost, but look at the marginal values. The chart says that it costs $8,700 to produce something that you can sell for $3,700. That's not a good way to get rich. Okay, so look at producing number 8. Same problem. The additional cost to produce is greater than the selling price. What about 7? That's the break-even point. The cost to produce it is the same as the revenue from selling it. That's the point where marginal revenue equals marginal cost, and that's the level of production that the entrepreneur should be looking for. If we fill in the profit column, we can see why. As long as marginal revenue stays above marginal cost, what happens to total profit? Right, profit continues to increase, and it only starts to fall when we get to 8 units, where the marginal cost is greater than the marginal revenue. And if we want to tie this whole process into the earlier part of our lecture, as the profit motive entrepreneur looking at this chart, what should you be thinking about? Well, according to Schumpeter, you're thinking about innovations that might help you lower the marginal production cost for units 7, 8, 9, and 10 so that you could make even more profit. All right, let's end by returning to our maps of rich and poor countries and reminding ourselves once again that wealthy countries are those where institutions and incentives encourage entrepreneurship and innovation to flourish. Increasingly, we see around the world how that flourishing improves the lives of the poor. Economies cannot advance without entrepreneurs, and profit is the incentive that calls forth their energy and ideas. We often hear commentary about excessive or immoral profit, but before jumping into that conversation, it's worthwhile to remind ourselves how much we benefit from the entrepreneurship that profit calls into our service, and to carefully consider that if producers cannot make a profit, they won't make the product. Second, in an open market economy, if producers are making profit, then people are voluntarily paying enough to induce the entrepreneur to keep making the product. And finally, if the market is open to entry and exit, and if property rights and the rule of law are firmly in place, the process of creative destruction will generate innovation and harness entrepreneurship to an ongoing process of improvements in human well-being.